Since the financial crisis, we have detected with our survey some changes in the trends and the approach of international executives looking at cross-border investment. Particularly, there is a growing and developing concern around making sure that businesses understand the local markets, risk and compliance factors, and they want to maintain a degree of control that perhaps wasn't so evident before. This may be called the new normal, it may be a developing psychological trend. 32% of those we surveyed said that Europe and the US would remain a priority destination for investment over the forthcoming years, even though 29% indicated that China too was the preferred country for international investment going forward. So we can reconcile these different statistics because there is the appetite for international growth and diversification, and of course the need to really develop products and growth going forward, and that takes us into Asia, but not at the expense of the West. So how do we reconcile this growing trend for investment in China and Asia on the survey results with a clear indication from many of our respondents that they prefer as well to keep investment local? We think it's because there has been a psychological change. We think that executives and companies really want to have a sense of control based around knowledge, perhaps in relation to compliance and risk, but also control over their people and knowing the trends in the markets. The outward bound investment trends into Asia can be reconciled with the investment locally into Europe, the United States, and the well-established Western markets.
Many of our clients have emerging market entry in their business plans. Direct exporting remains the most popular type of cross-border activity companies are engaging in, according to our latest research with the Economist Intelligence Unit. However, joint venture partnerships are often an alternative that is prioritised ahead of direct importing to alleviate some of the risks associated with going it alone in a new market. A joint venture presents an opportunity to share risk. It enables a company to partner with a local entity on the ground, bringing the benefit of local market insights and knowledge, while sharing the risk of entering into the market. It will often also help to overcome local regulatory issues. Early stage preparation is key to a successful joint venture. Companies must exercise due diligence, thoroughly research their partner to make sure it's the right fit, have a strategy flexible enough to accommodate the unfamiliar cultural environment, and understand how shareholders will view the partnership. M&A is at last again on the rise as a type of cross-border activity due to the changing economic landscape, with many companies seeing growth opportunities in new markets. And barring any unforeseen crises, we expect to see increasing levels of M&A activity over the next period. We have certainly seen a recent significant increase in US to European M&A activity. The US, however, remains still cautious about M&A in emerging markets against established markets, where they're more familiar with regulatory concerns and cultural differences. Financing remains an issue for cross-border activity. However, it is not the barrier it was a few years ago as enthusiasm and flexibility grow, and a variety of new and alternative financing opportunities are becoming available. Ultimately, Eurozone issues are still hanging over our heads. But there is a good upward trend in cross-border activity, not just M&As, with the financial services, media technology and energy natural resources sectors being the strongest areas of activity.